So China growth has certainly confounded markets. We saw a really strong Q1 GDP print, and that led to a ramp up in China's full year growth potential. Now, what we've seen in the second quarter, so official PMI slipping back into contractionary territory, weaker loan growth, and just ongoing property sector woes, we now see growth expectations coming in the 5 to 5.5% range. So from a policy standpoint, the PBOC has really delivered on easing, but we believe investors are looking for more. We think the late July Politburo meeting may open the door for a fiscal package. Now, the package probably won't be a silver bullet for the economy, but we do expect a plan that provides aid to targeted sectors. A policy mix that supports both consumption and better property demand could be on the horizon. We've been really just impressed with the broad resilience of EM economies across our landscape. Southeast Asia and India delivered really strong first quarter growth numbers. The Asia region, even absent a very strong China growth tailwind, is still poised to, lead the global economy in growth. So we've been watching two interesting developments out of India and Mexico. And what we're seeing is these economies are really starting to benefit from the relocation of supply chains away from China to different emerging market economies. In the case of India, we're really seeing the country capitalize on the China Plus One theme. So what is China Plus One? Well, it's simply a business strategy for companies to expand their operations beyond China, with the goal to really diversify their supply chain risks. So in the case of India, we've been seeing companies like Apple ramp up production facilities there, and that's translating into stronger Indian export growth. Similarly, in Mexico, we're sort of seeing a similar dynamic. They're capitalizing on the nearshoring theme. So nearshoring is simply companies trying to move their operations closer to their end markets. Now, obviously, given Mexico's proximity to the United States, it's a clear beneficiary and a clear choice for multinationals to gravitate there. In terms of data and evidence, I would say most of what we're seeing in Mexico is pretty anecdotal at this point, but we're really closely monitoring the data to see feed through into the country's economic stats. We know that, the shifting of supply chains is not going to happen overnight. It requires significant investment in labor and infrastructure, but it does really present a lot of emerging market economies the potential to capitalize and attract foreign direct investment. While EM growth deceleration is certainly a risk in the latter half of the year, what's important to know is that inflation in many of these economies look like it's either peaked or is near its peak. So that's going to give central banks room to signal an easing cycle. It will also allow them to refocus on growth prioritizations. We really expect the global growth slowdown to be led by developed market economies. So as a result, when we look at the EM-DM growth differential, we expect it to widen in the favor of EM to multi-year highs. So when you think about a better emerging market growth backdrop, coupled with EM credit yields in the 7 to 8% range, we see strong carry and attractive total return opportunities in the space. Broadly speaking, what this year has shown us is that emerging market economies have become much more resilient to challenging macro headwinds.